High returns always come with high risk, right? Well, maybe not. There is a lot more to an investment than just risk and return. In our new Bucks Outside the Box series, we are busting money myths and ripping up the conventional playbook for investing and personal finance. I'm Brian Davis.
And I'm Denny Sapley. And together we founded Spark Rental and the Co-Investing Club. We question everything so that you will question everything.
Amen. So people tend to think one-dimensionally about investments. They just look at that line between risk and returns. And they think that, oh, low risk investments must be low return and vice versa. Oh, high return investments must be high risk. That is actually not true at all. Investing is three-dimensional. There are many different factors that go into whether an investment is a good fit. And in our experience, and we have done over 30 passive real estate investments in big investment deals. We have over 3,000 units worth of ownership that we've invested in fractionally. And I can tell you firsthand, a lot of those investments came with high potential returns and low potential risk, but there were other factors at play here. And the first of those is liquidity. These investments that we tend to make in our investment club, our co-investing club, these are non-liquid investments. You cannot pull your money out once it's in. It's not like buying a share in a stock or an ETF where you can just click on the sell button at any time and sell instantly. That's not the case. You can't pull your money out. These are illiquid investments. Once the money's in, it's tied up until the operator sells the property or refinances or pays back your note or whatever the investment is and however it's structured. But there's no liquidity. And you have to be okay with that. That is another dimension here of these investments. And a related dimension is the time commitment for these investments. So for real estate syndications, which is not all that we do, but a lot of the investments that we make as an investment club are in real estate syndications, which are basically group investments where you become a fractional owner in a big property. They have a long-term time commitment, it's usually between 3 and 7 years, sometimes longer, before you get your money back. And not only is it a long-term time commitment, but you don't have an exact date in many cases of when that money is coming back. So the operator might say, we're planning on a 3 to 5 year exit, but it could be 6 years, it could be 7 years. You just don't know because if it's a bad market for selling that property, and again, I'm just using an example of real estate syndication to illustrate this. If it's a bad market for selling, then they shouldn't sell, right? Because you're going to get bad returns on your money. So they're going to hold out a little longer. You guys can collect cash flow a little longer, but you have no idea when you're going to get your money back. You just have a broad range.
Right. What kind of minimum investment is needed for all this?
Well, so it depends on what you're investing in. So if you're investing in stocks, then the minimum investment is just the price of one share, right? And the same thing goes for ETFs or REITs, any kind of publicly traded investment like that. With real estate, if you're investing actively, then you have to put down a down payment, you have to cover closing costs, you might have initial repair costs. The lender might require cash reserves. So you're typically looking at a minimum personal investment of 50 to 100 grand if you're going out and buying a rental property by yourself, for example.
Mm.
Now, if you're investing passively by yourself in a hands-off real estate investment, then it's the same thing. It's usually 50 to $100,000. Now, you can reduce that by going in on these investments with other people. So in our co-investing club, that's part of what we do. We meet every month. We go in on these investments together. So each member can invest with 5,000 or more. But that is atypical, right? I mean, so
Mhm.
we're going in on these together, and you can do that yourself too, right? You can go out and form your own investment club with your friends and family and go in on these together. But if you're investing by yourself, you're typically looking at a minimum investment of 50 to 100 grand. And we've seen investments with a minimum of $250,000 investment. I've heard of some with $1 million minimum investment. So you can
See,
find the best investment in the world, super, super low risk, crazy high returns, everything else looks wonderful. But if it has a $250,000 minimum investment and you don't have $250,000, you're up the creek without a paddle, right? You can't invest. So here's the,
what
yeah, go ahead, Denny.
I'm just curious because what if you are non-accredited? Like a lot of these are for the doctors and lawyers and whatnot. But what if you're just a regular person and
Well, that's an excellent point. That brings us to the next dimension to these investments is are they even available to you? So the SEC restricts some investments to accredited investors only. Now, accredited to qualify as an accredited investor, you have to have a minimum net worth of $1 million or more, not including equity in your home, your primary residence, or you need to have a minimum income of 200 grand a year for each of the last several years, or 300 grand if you're married and filed jointly. So again, you could find the best investment in the world, but if it's only open to accredited investors, you can't invest, even if you have the money to invest.
And Brian, are there tax benefits for investors in these?
Absolutely. And that is another dimension to investments. Different investments come with different tax benefits. So, for example, we invest sometimes in our co-investing club in notes. We invest in private notes, which are, it's a debt investment, right? Where we're lending money to a borrower, usually a real estate operator, and they pay us back a certain amount of interest every month. And then, there's a certain term. At the end of the term, they got to pay back the full loan amount, et cetera. But that interest income, we get a 1099 INT at the end of the year, and that interest income is taxed as regular income tax, as the same rates. There are other types of investments like real estate syndications. These are equity investments where we become a fractional owner in a large property. And those we get a K1 form for at the end of the year. And we get some really good tax benefits on those. So for example, we can show losses on paper on our tax return for those due to things like bonus depreciation
Mm.
and cost segregation studies to maximize the depreciation for these upfront. So even though we're collecting cash flow from these every month or every quarter in the form of distributions, so we're collecting real money in the real world, but on our tax return we're showing a loss, which is awesome.
Yeah.
But that just and other investments come with different tax benefits as well. But this is another dimension to investments. Different investments come with different tax benefits. And so it's not all about risk and returns with these investments.
And then let's discuss diversification because I know that I love that aspect. And go ahead and talk about the different ways and different, yeah, go ahead.
Yeah, well, so absolutely. Some investments come with built-in diversification. So for example, we've invested in it was a syndication that owned four mobile home parks plus a storage facility, or another one. We invested in one that owns two multifamily properties and a big retail center under the same investment, right? Contrast that to someone who buys a single family rental property and has the same amount of money tied up in each of them. So it's not about the money in this illustrating this particular point. But, you know, in one case, you have money tied up in hundreds upon hundreds of units across several properties and multiple buildings, different property types, different asset classes, and it's the same amount of money as someone who has all of that same money tied up in a single family rental property in one little neighborhood in one city. So some investments come with more built-in diversification than others, and diversification also is sort of a sister point to that minimum investment point that we made earlier. If the minimum investment is $100,000 in, investment A versus $5,000 in investment B, well, you could invest in 50 different investment Bs, right? Or not 50, 20 different of those investments at 5 grand a pop for that same one investment that took up 100 grand, right? So
Right.
the lower the minimum investment, the more you can spread your money around across a lot of different deals, in different geographical markets with different operators, timelines. We talked about investment timeline and when that money repays. So if you can invest your money across a lot of different deals, you can spread that timeline out. So, oh, this investment pays back in 1 year. This one is going to come back in 2 years. This one's going to come back in 3 to 5 years. This one is just 9 months. But you can spread that out over time. So, there's a couple ways of thinking about diversification here that, again, is another dimension to these investments.
And what about recession resilience?
This
Try
is
saying that five
I
times.
know, right? This is a question that, Denny, you and I ask ourselves every time we vet a new investment.
Yep.
So every week when we have investments that come across our plate and we look at them as like, oh, is this a good fit for our co-investing club? Is it not? And one of the first questions that you and I ask is, well, if a recession hit tomorrow, how would this investment fare? How would it do? What would happen if the Fed doubled interest rates or cut them in half? How would this investment do under these different scenarios? And what we like to see is higher resilience in these investments. So here's a quick example. The investment that we invested in this month in our co-investing club, it's an industrial real estate deal. It's a seller leaseback deal where it's a single tenant who they do commercial weldments and machining for big they're a contractor that serves other contractors and other major corporations. So one of their biggest clients is the US Navy. They work with SpaceX, they work with Westinghouse, among many others. So they're pretty recession resilient. The US Navy is not going to stop ordering ships, right? And in fact,
And if they
they're
do, we're in trouble.
yeah, I know, right? And then we have bigger problems. Yeah, if the U.S. Navy disappears, then we all have bigger problems. But yeah, so not only do they have a diverse client base, it's very recession resilient, and they have an order backlog for the next 4 years. Like through the end of 2028, they're booked up. Their business is completely booked up, and that has been the case for years in the past too. They book out their book of business years in advance. So if this investment is a 3 to 5 year timeline investment, they're already booked up the next 4 years, basically. So, I'm not really worried about them defaulting on their rent payments, right? I mean, they are well poised to weather any storm that comes. So anyway,
Mhm.
that's one quick example, but we can give you a dozen other examples if we had all day here of different types of investments we've made, not just syndication investments like that one, but different investments that we've made that are pretty recession resilient and that we feel good about. If different economic changes come into place, they'll still be okay.
Right. Personal values. Talk a little bit about that because it's something you wouldn't think would have an effect.
This is so true. And this is, again, one of those counterintuitive things. This is exactly what you and I like to be talking about on this show. So here's a quick example of how an investment might have low returns. I'm sorry, low risk and high returns and still not be a good fit for you. So there are a lot of people out there who are very environmentally conscious and they don't want to have their personal money tied up in oil and gas drilling. However, oil and gas drilling over the decades actually has a really good track record of low risk and high returns. It has averaged 15 to 20% through a lot of different market cycles. So historically, yeah, this is an asymmetric investment with low risk and high returns, and it still might not be a good fit for you as an investor, right? So again, it's just thinking three-dimensionally about all of these other factors, all these other dimensions to investments that have nothing to do with risk or returns.
Well, and if you think about it, there are many types of risk, correct?
Yeah, and that's the other thing about this is even if we're just looking at risk and versus returns, risk in itself comes with all these different facets to it. And even returns, less so, but that still has some different facets to it too. So let's talk just for really quickly about the many types of risk here. It's not just a monolith. It's not all under this one umbrella of risk. So you've got volatility risk, right? Which is basically
Hmm.
price risk. How much does the price bounce around in a given period of time? Stocks, for example, very, very high volatility. Real estate, much less volatility. Prices still do move though. Rents have even lower volatility. Rents have very little volatility. Anyway, so that's one type of risk is volatility, price risk, basically. There's inflation risk. Some investments have very good inflation risk. So they're inflation resilient. So, for example, gold, real estate, even stocks actually have pretty good inflation. So if the inflation rate surges, these investments tend to keep pace with it and just tend to adapt to it. There are other investments that are extremely vulnerable to inflation. The easy example, the classic example is bonds. If you have, and this is a real life example from a couple years ago, there were people with treasury bonds, they were holding treasury bonds that paid 2% interest, and then inflation jumped to 9.1% in 2022. So they're basically losing 7.1% on their treasury bonds. And yet, in the next breath, they'll tell you about how safe treasury bond investments are
Right.
because they're talking about default risk, which is another type of risk, right? And that's another type of risk here is default risk is for debt investments or even for certain types of real estate investments where there's rent. So default risk, the person could stop paying you, right? So default risk is a type of risk. It's just not the only type of risk. So when you talk about treasury bonds being low risk investments, you're talking about default risk, and you need to be very precise about the type of risk you're talking about. There's disaster risk, which is
Which
something
is
that,
crazy. That's something that's really come to light lately.
well, yeah, especially in the real estate world, like you and I are, Denny, disaster risk is very real. The worst investment that you and I ever made was, or at least in our co-investing club, it was in Florida. It was a pair of properties, and it did not get hit by a hurricane or anything, but the insurance premiums doubled in 12 months because there had been so much other hurricane damage nearby. So, and as we're recording this, this episode will probably air in a couple of weeks, but as we're recording this, there are three massive wildfires raging in California. So disaster risk is a factor, especially in real estate investments, where, there are parts of the country where there's almost no disaster risk, right? And parts of the world where there's almost no disaster risk, and parts of the country where that disaster risk is really high. And then you've got political and regulatory risk. So, in some areas and for certain types of investments, the regulations over time have just gotten tighter and tighter and tighter and tighter. And that is especially visible in extremely tenant-friendly states and cities for residential real estate. But that risk doesn't apply to, say, industrial real estate, right?
Right.
So, and here's another quick example of that is if you look at short-term rentals and Airbnbs, there are some cities, they've just outlawed it, basically. And even if they haven't, precisely outlawed it, they've made the rules so tight that it's effectively outlawed. So these are examples of political risk and regulatory risk that, are another type of risk that you
Mm.
have to consider. And then finally, there's concentration risk. How much of your money is all tied up in the same type of thing? So if that one thing crashes, then you're really in trouble. So we touched on this a little bit earlier about
Mhm.
diversification, and that's one of our core values as an investment club is diversification. It's not having that hubris of thinking that we can predict the future, that we can predict the
Right.
next hot market or the next hot asset class, or that we can time the market perfectly. I think that is total hubris. It's a myth. It is just arrogance. So we're big on diversification.
Which
Anyway,
means we don't put all our eggs in just one basket.
man. So, a quick recap of everything we talked about today. So, there's a lot more to investments than just risk and return. There's liquidity, there is time commitment, there is the minimum investment, there is accessibility to non-accredited investors if you are one of those. There's tax benefits, there's diversification, there's recession resilience, there's your personal values, and even when you are looking at risk, there's a lot of types of risk. There's volatility, there's inflation risk, there's interest rate risk, there is default risk, there's disaster risk, there's political and regulatory risk, and there's concentration risk. So, on that note, do we cover everything we were supposed to cover?
Well, I just want to make sure that for anybody that's listening, if you're considering joining our co-investing club and taking your financial journey to the next level, and you want a free course on how to invest passively, visit sparkrental.com/free.
And guys, if you got a fresh perspective out of this episode, pay it forward. Pass it along to someone you know who might need to be shaken up a little bit in their money beliefs. And if you didn't get anything out of this episode, email us and tell us. Email us at support@sparkrental.com. Let us know what you want to hear more about moving forward. All right, on that note, stay weird, unconventional investor.
Have a great